Welcome to this video on strategic finance for college students. Chapter 1 introduces strategic finance as a decision framework. It links goals with resources and creates measurable value. Strategic finance differs from other fields. Accounting focuses on past records, economics deals with system theories, while finance centers on forward-looking decisions. 4 core questions drive strategic finance. Where should we invest? How should we finance those investments? How do we manage liquidity? And how do we distribute returns? The finance planning cycle involves a long-term strategic plan, an annual budget, and regular forecasts for updates. Within an organization, roles include the board for strategy oversight, the CFO as partner to the CEO, the controller for reporting, and the treasurer/FP&A for cash and analysis. Chapter 2 covers the time value of money. Time matters because of opportunity cost, the impact of inflation, and the presence of risk and uncertainty. We explore interest rates, distinguishing between nominal versus real rates, understanding the effective rate, and considering central bank policy. Compounding, the exponential growth of money over time, is key. Starting early provides a significant advantage due to this concept. The basic formulas for present value, PV, and future value, FV, allow us to compare money across different points in time. The rule of 72 offers a quick mental math shortcut. Divide 72 by the rate of return to estimate the doubling time of an investment. This has strategic applications. Chapter 3 focuses on financial statements. There are 3 key statements: the income statement, the balance sheet, and the cash flow statement. The income statement shows layers, from revenue to gross profit, and then down to net income. Margins across these layers indicate a company's financial strength. The balance sheet adheres to the fundamental equation: assets equal liabilities plus equity. Equity represents the ownership value. The cash flow statement is divided into 3 sections: operating, investing, and financing activities. Financial ratio analysis helps assess profitability, liquidity, efficiency, and leverage. Chapter 4 addresses risk and return. A core finance principle is the trade-off. Higher potential return comes with higher risk. There are different types of risk to consider, including market, credit, liquidity, and operational risk. We can measure risk using tools such as standard deviation, beta, value at risk, and the Sharpe ratio. Diversification means spreading investments to reduce unsystematic risk. However, it cannot eliminate market risk. It's important to understand the difference between risk capacity, your financial ability to absorb losses, and risk tolerance, your psychological comfort level. Chapter 5 discusses financial markets and investor behavior. Market functions include price discovery, capital allocation, liquidity provision, and risk transfer. Financial markets are categorized into types such as capital, money, foreign exchange, FX, commodities, and derivatives markets. Key market participants include retail investors, institutions, banks, and regulators. The efficient market hypothesis has 3 forms: weak, semi-strong, and strong. Behavioral biases like overconfidence, anchoring, loss aversion, and herding can influence investor decisions. Chapter 6 covers the economic environment and inflation. Key indicators include GDP growth, unemployment rate, inflation rate, and interest rates. Inflation is a sustained increase in prices, which reduces purchasing power. It is measured using indices like CPI, PPI, and PCE. Optimal inflation, often targeted at 2 to 3%, encourages spending, eases debt burdens, and provides flexibility for policy decisions. Deflation, or falling prices, carries risks like delayed consumption and rising real debt burdens, making it difficult for an economy to recover. Inflation has significant business implications for pricing strategy, wage management, asset choices, and financing decisions. Chapter 7 focuses on working capital management, defined as current assets minus current liabilities, crucial for day-to-day liquidity, survival, and growth. The cash conversion cycle, or CCC, measures the time it takes to convert investments into cash. A lower or negative CCC is generally considered ideal. Managing accounts receivables involves setting clear credit standards, defining payment terms, and establishing effective collection policies. Inventory management uses tools like the Economic Order Quantity (EOQ) model, ABC analysis, just-in-time JIT systems, and safety stock. Working capital strategies range from conservative to aggressive, aiming to balance liquidity and profitability while matching industry norms. Chapter 8 addresses investment decisions and capital budgeting, which includes evaluating expansion, replacement, new products, and strategic projects. Net present value, or NPV, is the gold standard metric. A positive NPV indicates value creation, while a negative one signals value destruction. Other metrics include the internal rate of return, IRR, where NPV equals 0, and payback, the recovery time. These should be used with caution. When analyzing investments, focus on incremental cash flows, ignore sunk costs, and include any opportunity costs. Chapter 8 concludes with common investment mistakes: ignoring inflation, forgetting working capital needs, overestimating synergies, and allowing politics to skew discount rates. Chapter 9 discusses financing decisions, focusing on the core trade-off between debt and equity. Debt is generally cheaper but carries higher risk, while equity is permanent but more costly. Capital structure theories include Modigliani-Miller, the trade-off theory, and the pecking order theory, each offering different insights into optimal financing. The weighted average cost of capital, or WACC, represents the blended cost of debt and equity financing, adjusted for the tax deductibility of interest expenses. Finding the optimal mix means balancing the benefits of debt's tax shields against potential financial distress costs, all while aligning with the overall company strategy.